Rainwater. Rainwater is a bulk infrastructure entity that actually provides bulk water as well as bulk sanitation. Basically, what our entity actually does is that we provide potable water to local authorities who then sell it to the end consumers. Our infrastructure network spans about 3,400 length of kilometers of pipeline. We've got over 50 reservoirs that actually then now stores water. On a daily basis, I think we supply close to 4,600 megaliters of water per day. We have an extensive, infrastructural program that we'd like to actually discuss with you. We are embarking on a renewal and augmentation program to increase our capacity to actually provide water. And our service area spans, the bigger part of the whole of Gauteng, Mpumalanga, parts of Free State here in South Africa, and the Northwest. I think we actually service close to 50% of the population of South Africa. We are one of the water boards that cover South Africa amongst 9, but we are the largest and the largest in Africa, as well. Thank you.
Hi, I'm Sujoy Bose. I'm the Director of Infrastructure and Natural Resources for the IFC. The IFC is the private sector arm of the World Bank. We are a global development finance institution that operates across the capital structure. So we do debt, equity, mezzanine. We also provide advisory services and technical assistance to companies and to governments. And we also have a development arm which can actually work alongside project developers in developing projects across the world. IFC focuses on playing a catalytic role in making projects happen and helping companies achieve what they want to do in their businesses. We have a very large syndications business, which we've been operating for many years. In 2009, we started an asset management company, which has become one of the largest fund managers for emerging markets. We currently manage about $9 billion under that asset management company. We have almost 50 institutional investors, sovereign funds and pension funds that invest through us. And we've also developed a co-lending program, which basically allows us to raise money from, again, institutional investors and invest alongside the balance sheet. So we have currently a $3 billion program from the Chinese, and we are about to launch a program with European insurance companies, which could actually be a very interesting program, looking forward. The infrastructure portfolio is about $14 billion across 70 countries globally. In Africa, we have a portfolio of about $1.5 billion in the core infrastructure space, which is basically power, transport, water, and utilities. And it's fairly well spread out between West, East, and Southern Africa, and growing at a pretty fast pace.
Thank you for providing us with context to your institutions and the role that you play in the infrastructure development and finance of projects. The first question is for Paul. Paul, as a research and intelligence provider, can you perhaps maybe set the stage by highlighting the driving forces behind infrastructure development and finance on the continent, as well as highlighting any targeted regions, if any, as well as opportunities going forward on the continent?
Thank you, Chair. I'd like to, as the title is about African cities, I'd like to start with that. And from the outset, just say that we maintain a project database. We have stringers in the markets assisting us. So we interact directly in the market. You can't sit in Johannesburg and know what's going on in Kigali right now. So you have somebody in Kigali. So we monitor it a lot from that point of view. And in doing so, I'd say there are two areas of particular activity, because we're sitting in a depressed climate right now with the commodity prices downturn. And a lot of people are sitting on their hands. But in the commercial property, industrial park, retail kind of sector, there's a lot of action. There really is, and it belies what this depressed climate, I must admit. The other area is data, where we see a lot in the ICT side, but I won't dwell on that. It's more, now relating to that, the urbanization in Africa is proceeding at a huge pace. Dar es Salaam, if you look at the history of Dar es Salaam, see what it was originally catered for, or Luanda. These cities are busting at the seams. African governments have realized that. So they are developing things like Kigamboni in Tanzania, Tatu City, Konza City. Those are related to ICT developments, industrial parks and so on. In Addis Ababa, there are something like 15 industrial parks in Ethiopia going up. There's one in Bole outside Ethiopia. So these are mixed-use developments often. And now this is the big thing for the financiers to understand, I think, and to understand from a practical point of view. The donors, not the DFIs, the donors, the government lenders and the governments, have to bring these projects up to bankability. There needs to be the basic infrastructure before the project becomes interesting to private investors. Because they're mixed use. Like, I'll give you a very good example is airports. I've got airport projects coming out of my ears at 3 levels: international, local, and of course rehabs of airports as well, not just new airports, but also rehabs, and also regional and smaller airports that are being given international status, like Nakala. An airport, like a hotel in Africa now, is no longer a standalone entity. It'll have, of course, it'll have a casino if it's a 5-star, but it'll also have a little retail sector, like Pemba Beach. Even in small Pemba, you'll find that there are apartments there. There are sports facilities. It's very, very mixed use. And that means that various players can have an opportunity in this area. In South Africa, we're particularly lucky, if I put on a selfish South African hat, in that we have 2 of the big players right under our noses. That's Atterbury and African Century. I'm not saying they're the only ones, but they are right here. So those developers, those project developers, are really at the forefront of things, and then they have to collect the finance. For example, in Palma, what we're doing a lot is we're looking at potential growth areas, like, for example, Palma, where the LNG plant will be from Anadarko. That place is going to have an influx of expats and locals as the LNG plant develops. And the people need to stay somewhere, and they need to be entertained and all that sort of thing. So if I may quote, well, I don't want to mention the name, but the one property developer that was there, he made a very interesting statement the other day. He's in Palma, and he said, "I knew I would have to wait, but I didn't think I would have to wait this long because of the commodities downturn. So the people are stretched at the moment." But airports, for example, are multi-use entities. There's also Africa Invest itself carries that there's there's a huge pipeline of hotel projects, especially in countries like Nigeria. It's quite amazing. The pipeline, Trevor Ward is a specialist on this, and is often in Africa Investor, who I also write for. There are, he gives you that scenario. The other thing to mention that's very, very important as we develop is industrial parks. I think industrial parks, if you see the program in Ethiopia, it's substantial. Countries are getting much more clever now with industrial parks. For example, in Nairobi, they have the Leather City Industrial Park, focusing on the leather industry, to give it focus. So that, now where would a private investment go into this? As I say, private investors would look at the project, see to what stage it's being developed, and then obviously the more developed, because there has to be the support infrastructure and all that sort of thing, with these industrial parks. An interesting case is the Industrial Parks Agency of Ethiopia. That is really an interesting case, because what it's doing, it's set up not like an ordinary state utility. It actually is a commercial entity. They have been set up in very posh offices in Addis to actually make money out of these industrial parks as a state utility. Secondly, they are assisting the private, because remember you get state industrial parks and you get private industrial parks. They are also assisting with the private industrial parks. So I think that that is a very, very important development. The ICT sector, as I mentioned earlier in Kenya, is also developing its own centers, like especially in Kenya, because Kenya is leading the way to a large extent in that regard. And then, as I say, some of the big infrastructure projects, like I was just looking at the Inga project, and you know there's been some movement on Inga. Let's not get too excited, but there's been some movement. I was looking and listening to the Congolese talking on this project, and I thought, you know what? We've got a project right under our noses right now. If you're going to develop Inga, and Inga 3 and Grand Inga, and Inga 1 and 2 already going, there is a need for warehousing, hotels, access roads, all kinds of things at the site in Inga. So why don't we present that as a project? Because if you're going to make money from the project, you know that there's going, you see, wherever we are in a country, in a continent of stranded resources. So you suddenly have a remote area. Look at Tet, what happened in Tet. Tet was a tiny little backwater. Now it has grown right out of proportion. How many people have been, I know it hasn't gone well. I know that because the coal price, and I know the hotel there has not done well. It has not worked out. But, you know, it could have been another way, eh? Could have been another way. What's going to happen in Palma on the back of the gas? Everybody's talking gas to power. So, you know, the whole city-urban development is also developing in the rural areas as well. These cities are bulging, and they are really... That's why Kigamboni was planned by the Tanzanians, because you have to... And usually that involves, like in Kitwe, a special bridge that will open up a certain area of Kitwe, the new Kitwe town. They have to do a new airport, because the airports are... Ndola is ridiculously inadequate. So I don't know, Chair, I know we've got a very short time, so I don't want to go on much further. I just wanted to throw out some of the things that are really happening, and maybe the clever finance guys can add to that. Thank you.
Thank you for that, Paul. It's very clear that Africa can no longer afford to have isolated infrastructure. We have to look at a more integrated approach to infrastructure development, and that it's clear that private sector development cannot happen until governments and states have adequately laid the basic infrastructure. Thank you for that, Paul. And moving on then to Daniel. Daniel, if you could kindly share the characteristics and features that investors, whether global or domestic, typically, the type of features that they typically look for in projects across the continent. And if you could also then respond perhaps to sort of innovative funding structures that you look at as RMB on the continent, whether it's in the equity space or the mezzanine space in particular.
Sure, thanks, Madam Chair. So, as I mentioned earlier, we don't specifically necessarily concentrate on funding equity ourselves or providing equity ourselves, but we do provide subordinated debt and mezzanine instruments and senior debt to a variety of projects, parastatals and municipalities. So I think we have got quite a cross-section of deals and projects from which we can extract, I guess, probably not an exhaustive list of characteristics that we see institutional investors are looking for in projects on the continent, or at least specifically in sub-Saharan Africa. And I think that these characteristics can apply regardless of whether you're funding into you want to invest into a project, if it's some sort of parastatal or municipal instrument as well. And as I said, it's not an exhaustive list necessarily, but I think it is broad enough to cover most bases. I think generally, if you look at infrastructure as an asset class, it's not the type of returns that you're going to get from private equity or venture capital, and I think investors, institutional investors, understand that. So because you are expecting a lower return than what you are in, say, private equity or VC, you're expecting to take lower risk. So these characteristics are important, in my opinion, when they analyze whether or not to invest in specific projects. And I'll try to give a couple of examples as I go through some of these characteristics. In no particular order. So the first one is policy certainty and legal framework certainty. So if you look at some of the success stories on the continent, the first one that comes to mind is the South African Renewable Energy Program. There was laws were put in place, a framework was established that really was the enabler and the catalyst for the success of the program generally. And I think it would be hard to argue that it hasn't been a success, but it was the groundwork that was laid by various arms of government acting in unison for the most part in putting that framework in place that I think largely led to the mushrooming of the sector and the success that they've had. The second point, and again, regardless of which sector you're looking at, I concentrate on the energy sector, so it may have that particular slant, would be creditworthy off-takers. And I think that if you look across the continent, hand on heart, there aren't a huge number of creditworthy African utilities. In fact, you can probably count them on one hand. And that's not necessarily in and of itself a deal breaker. Projects are done across the continent every single year. But you do need credit enhancement or mitigation tools to enable you to make that project bankable. So whether it's a government guarantee to the extent that the government is sufficiently creditworthy, whether it's support from multilateral agencies, DFIs, PRG programs from parties like the World Bank, those are the kind of catalysts that are required to I guess, start off a sector. One example I can think of is what's happening in Nigeria. The structure that's been put in place by the World Bank and its various arms has been successful. There was a transaction that we were fortunate to be one of the MLAs on, which closed in Nigeria at the end of last year. I know Helen's company was one of the sponsors there, called Azura, and that was really as a direct result of the reforms that had been pushed by the World Bank and the support that they gave to the various parties or players within that sector. The next characteristic would be a solid payment history. And I think there are one or two examples of where those sorts of payment histories are potentially wobbling across the continent now. But something like South Africa is an example where even when we got to the renewable energy program, there had been a strong payment history by government in its various, whether it was a specific department, a municipality, a parastatal, of paying under PPPs. So when it came to discussing whether there was a risk of Eskom or backed by the government in this instance not paying under an RPP program, I think there was generally a high degree of confidence that they would pay because of the history of paying under PPPs. The next characteristic would be the line of sight of a program. I think it's difficult for institutional investors to invest an enormous amount of time, resource, and capital in investing and bringing a project to fruition, because it does take longer in emerging markets than what it does in developed markets. And I think it's difficult for institutional investors when there's one lone project. When you can see a number of projects on the horizon or a program like what you're seeing in Nigeria, for example, there's a line of sight of a number of projects in Ghana. That incentivizes institutional investors, I believe, to dedicate resource, time, and capital to analyzing those projects. A small point is also the potential for upside in your project. As I mentioned, infrastructure assets have a general range of returns, and if there's upside potential by way of refinancings, expansion of plant to boost your equity IRR, I think that is attractive. And then I guess the last 2 points, which I know have been spoken about over the last couple of days. One is hard currency returns, particularly important, obviously, for global institutional investors. And that, again, is something that's been solved in a number of deals, whether it be in West or East Africa. There may be PPAs that are paid in the local currency but are linked to the US dollar. So in that way, the institutional investor who actually wants a hard currency return, in that case predominantly dollars, is able to extract that in spite of the fact that the actual payment is in local currency. Which I suppose brings me nicely on to the last characteristic, which is obviously political risk insurance. As I think Helen mentioned, there are some less, I guess, should we say, stable jurisdictions that some of us play in, and because of the long tenor that's required in infrastructure investments, you do need, both on the debt and the equity side, the ability to access political risk insurance both in the public and private markets. So that catalyst that those entities bring to bear on these sorts of projects is obviously critical, and to be honest, I think a number of institutional investors would simply not look at projects if they didn't have that political risk mitigation. Thanks.
Thank you. The next question is for Kevin. As a property developer, and looking at the rapid economic growth and the urbanization and migration patterns in Africa, these have clearly necessitated a need, an urgent need for for development of cities and for infrastructure spend. What opportunities do you see existing for institutional investors on the African continent, in particular looking at African cities?
Thank you. I mean, obviously, as I initiated sort of 20 minutes ago, we pretty much are the end user, because what we do, we build malls and we own malls in different jurisdictions. So we need good, clean infrastructure in the markets where we go into. Unfortunately, that hasn't been the case. And I'll give you a few examples of the journey that we've gone through. But I think before I go to that sort of micro level, I would rather talk about sort of macro. Because I think, you know, over the last day or so, I've heard a lot, which is good. I've heard a lot about funding being available from the private sector, even from the sovereign wealth funds as well. I think there was a session prior to ours. You know, there's lots of funding being quoted for the continent. But I think one needs to take stock of what's also happening on our continent. So what I mean by taking stock is we've had a fantastic 10 years from 2005 up to 2015. The reason I say this is a lot of the markets where we've invested are markets which were the flavor of the month. There was a consumer thesis that was being sold to global markets. It was a time when places like China was having high growth of around 10%. And it's interesting, I'm going to talk about China relating back to Africa. I spent a week in Beijing 3 weeks ago. And for me, it was an eye-opener. It was also a good takeaway from China, which is also going to impact on our continent. So in what sense? First, I think China have acknowledged that the growth story for them going forward is going to be around 4 to 5%. They've also acknowledged, which is quite interesting, that they've stockpiled sufficient amount of resources for many, many years to come. And the statistics are pretty frightening for somebody who's not in the domain. The statistics goes they've stockpiled sufficient steel for the next 20 years in the warehouse. So they don't need to buy any additional steel for the next 20 years. Second statistic, they've stockpiled cement, which will allow them to build a 6-lane highway from Earth to Mars. And the reason I'm saying this, I think it's very important I say this, because when in 2014 the oil price dropped from triple digit to double digit, a number of people thought it's going to be just a 6-month or a 1-year blip. And we're already 18 months from 2014, and the oil price is even lower, is hovering around in the range of 40s. So I think, having been on the continent since 1998, I've seen the continent in different phases. And the reason I say the last 10 years has been a fantastic 10 years, I think the issue is what's going to happen in the next 5 to 10 years. My view, I think it's a new norm out there. And the reason I'm saying it's a new norm, and you need to understand in the global perspective, even Christine Lagarde, who is the MD of IMF, came out strongly last week to say, going forward, the world has to adopt a new norm. So what does it mean? A new norm means much lower growth on our continent. So, and this is something which we're already seeing. Take countries where we've invested. Ghana. Ghana used to grow around 7-8%. This year, they're going to be lucky if they're going to strike 3%, 3.5%. In a year where they've got election, when we know when there's election, governments spend far more money than ever. Zambia, same story. The growth has also halved. You know, Nigeria is going for a very, very difficult time as we speak. There isn't a single dollar in the market. We've been trying for the last 6 months to get $10 million out of the banking system. There's nothing unless you go to the parallel market. But the question is, who's feeding the money in the parallel market? So I think that's why you need to take it in the perspective of what's happening from a macro point of view. So in that macro point of view, also, if you look at what's been happening over the last 5-6 years, a lot of countries on the continent went on a shopping spree in the Northern Hemisphere, raising huge amount of dollars and on the back of Eurobonds. So countries like Ghana, Nigeria, Cote d'Ivoire, Senegal, Kenya, they all went and raised huge amount of money. Unfortunately, what happened in Mozambique 2 weeks ago with them defaulting just doesn't help. I was in London last week and meeting with investors. They don't care about it's a Mozambican issue. For them, it's an African issue. So it impacts on the fundraising of other countries. So a lot of governments who raise money over the last 5-6 years have been raising around 5% to 6% from a yield point of view. And when you look at the yields currently, you're talking double digits. So the same governments that had access to $1 billion 3-4 years ago at 5%, 6% interest rate, now can go to market, can only raise at 11, 12, 13%. So what does it mean? It means basically a revision of investors' appetite and also, I think, a more comprehensiveness of the risk return of the continent. And I'm going to come back to how does this play for us. Yeah. So I think for me, it's going to be interesting to see how much money will be deployed tangibly in infrastructure over the next 5 to 10 years. I'm not skeptical. I'm an African at the end of the day, so I have to be positive about it because it does impact on our business. How does it impact on our business? Just to give you a few case studies. I spent, prior to being the founder CEO of At Africa, I spent around 7 years with Actis. They were the premier private equity funds on the continent. And when we built our first mall in Accra, obviously to build a mall, you need to have good access. You need to have good reliability of power. Unfortunately, we didn't have both. We relied on government to help to expand the road around the mall. And 8 years later, they haven't done it. And we currently we had to buy land end of last year, and we'll probably have to do it ourselves. And then when it comes to power, in most of our malls, we actually create our own power. So what happens is we invest additional amount of money, which costs us around 5 to 10% additional on top of your total development costs to produce your own power. So if you go to our mall in Accra, we've got a generator that operates full-time, and we've got 2 backup generators. Typically in your first wall or in South Africa, you'll rely on Eskom, and if it doesn't work, you rely on your backup. There, our backup is our primary generator. That's the reality. Secondly, we built a new mall in the western suburb of Accra, which is called West Hills. That was opened a year and a half ago. And during the construction phase, there was an agreement with government, because it was built on the major highway from central Accra to the western suburb. There was agreement with the government that they would unlock access to our scheme, which unfortunately they didn't do it. We had to spend additional $12 million on top of our $90 million, so that's quite a lot of money on top of our total development costs. And we had to do it ourselves. So where does this lead us? Yeah. So I think if we're going to keep, and I heard somebody else prior to this panel, I think, talking about the last mile. I think if we're going to keep waiting for government to make it happen, I'm quite skeptical. So I think either the private sector need to take the initiative, or they need to hold the hands of the government and drive the initiative, then I think it will happen. And the reason I'm saying this, take Nairobi as a classic example. They've opened a ring road from the south of the airport, the Nairobi International Airport, to unlock going to the north of Nairobi, which prevents you from going through the center of Nairobi. Instead of building a three-lane highway, they built a single-lane highway. I don't know how they call it a highway, it's a single lane. 1 year after opening, the traffic that should have taken you 20 minutes from the airport to go to the north takes you 1 hour and a half. Yeah. The traffic within downtown Nairobi hasn't been solved. It's actually gone worse. I think it's ahead of Lagos, if I'm not mistaken. So I think the issue here is we're always trying to catch up. And myself, from a real estate point of view, I'm frustrated because I'm going to say, when are we going to stop catching up? And when is the private sector going to really sit down with the government and drive this? And I think in maybe my lifetime, which might be 10 years of work life, I think we'll still be catching up, because I think there are lots of headwinds coming our way. But having said that, there's far more amount of money as we speak that's been raised. And I think the private sector needs to drive that. I'm I'm not optimistic about the government. We've seen what the Mozambican government have done with the $900 million, which is supposed to be off balance sheet. So a plea to the private sector, including the IFC, who's doing a good job, is please drive that initiative.
Thank you for that, Kevin. So what stands out to me, Kevin, from your discussion is clearly the need for African countries to diversify away from commodities. So it's very clear that you've mentioned China stockpiling, or rather the drop in demand for Chinese imports of iron ore, as well as slowing growth rates that necessitate African governments then to look deeper and say beyond, what is there beyond commodities and agri for Africa? Thank you. And then moving on to Ravi. Ravi, if you've already introduced who Pembani is, but if you could kindly share your investment strategy and probably appetite and your pipeline of projects on the continent currently.
Thanks. On our investment strategy, I think it's best to look back how we structured this fund. When we sat down and said, okay, what are we going to do with this fund? We said infrastructure. Okay, that's great. So we would then look at all your your traditional stuff, your power, your road concessions, and your terminals and ports. That's great. That's fantastic. How can we be a little different? Because we realized, look, there is potentially enough cash out there. We need to invest. And we had to sit down and think, how do we differentiate ourselves? So we had to create a bigger investment universe for ourselves. And what we said was, okay, we'll do all the traditional stuff. We'll do the greenfield stuff. We'll do the brownfield. That's fantastic. But let's also think about investing in operating entities, more of PE transactions that have a infrastructure angle to it. So, it's a very, I think the definition of infrastructure is getting assaulted every day. It's a simple example. Growing up, I never thought I'd see the day, but out there you see a proliferation of entities going and selling standalone solar panels to homes across Africa. Okay, now originally you would think this is selling of power. You would need the national utility of the country to come in and provide that power. Guess what? We're getting into the FMCG space now. And it's fascinating to see that, there's a shift in the definition of infrastructure because FMCG is coming in to this space that we were all so comfortable about. So it's fascinating to see what's out there. So, but let's talk about a bit of our transactions. Our first transaction was, wait for it, an agri trading processing entity in Dar es Salaam. What does it do? It collects commodities from your subsistence farmers, aggregates them, takes them through the aggregation centers, to the warehouses, to the ports, takes the commodities straight to destination markets, and uses the same warehousing aggregation infrastructure from there, buys up fertilizers, uses the chain of infrastructure, and sells it off to the farmers. So it's bidirectional. And we looked at this and we said, look, someone's going to say this is agri, right? Okay, everyone in the room says, what's an infrastructure fund doing in the agri space? Well, we thought, let's look at it differently. This is actually infrastructure. There is a network of underlying logistical infrastructure that is underpinning this business. And we as a fund with an infrastructure view, it's easy to legitimize. And that's what we did. So, and the next one we looked at was Okay, let's start off by saying rail, transport, rail. You've got rail concessions, you've got, there's such a need to rehabilitate, in fact, rail networks on the continent. That's great, that's fantastic, but what are you going to put on it, right? So we started a leasing entity, a rolling stock locomotive leasing entity, actually with Grindrod, who is an OEM manufacturer and provides a servicing arm, a maintenance arm. And what we do is we set up an entity to lease out locomotives to mining houses, railway utilities, and whoever needs it. Because what we found was, I've done trips to some of these countries. They've got 30 locos. Guess what? Only 5 or 6 are actually running, because the rest are supplying parts to these other 5, 6. So there's cannibalization going on, and the guys always say to the guys, well, why don't you buy? What are you doing? We can't afford to buy. We just can't. So that's where the idea came about, to start giving a different angle to this, is to say, here's another different form of financing. You lease the transaction. Lease the locomotives. So I think, we're an infrastructure fund, and what we're trying to look at is trying to look at this infrastructure space a bit differently. I think it's important to look beyond the notion of infrastructure we used to. I talked about the off-grid infrastructure, but looking at, for instance, industrial warehouses. Someone might say, wait a minute, that's property, but that's also infrastructure. That's logistics, and we think the actual one of the biggest drivers from our end, it's actually power and logistics. We're seeing logistics as a great opportunity on this continent. Logistics is what eventually is going to glue up an economy. And and even if there's even a 0% growth rate, there is an underlying economy with inefficiencies that need to be sorted out. And so that's how we see our play on the continent. Thank you.
Thank you, Ravi, for bringing a different paradigm to infrastructure and stretching sort of the definition of what infrastructure is and challenging all of us. And it's interesting to hear about the innovative ways in which you found the innovative ways in which you stayed within your mandate that you'd been given by investors, but yet you still managed to create opportunities. It's interesting in the way you framed the PV panels as FMCG, and that's the reality. It's here today, gone tomorrow. Exactly. Sold within minutes. And then also interesting is how you've managed to sort of incorporate, and I think it's with the ETG story, incorporating the small industry players into the wider and mainstream economy, as well as the rolling stock opportunity. There are very few. It's a well-developed market in Europe in particular, but on the African continent we're seeing very, very few players. Actually, you're the second of 2 players in South Africa. And the IDC has had the opportunity to be a co-investor in your competitor. Great, thank you for that. Great. And the next question then is for Helen. Helen, you represent a wide range of investors, ranging from DFIs, NGOs and CSIs, as well as private equity players. How have you managed to align the risk appetite and return expectations of your various investors as and when you develop and finance projects on the continent?
With some difficulty, I think it's fair to say. Nevertheless, I think we are an interesting animal, or we think we are, because although we're a private company based in London, our biggest shareholder by far is the Pan-African Infrastructure Development Fund, which is based here in Johannesburg. And in that fund, the biggest investor is the Government Employees Pension Fund, who is sitting here deliberately not looking at me. So, in addition, we have co-invested quite recently with GPF in refinancing the equity in the Kelvin power plant with a view to its future life. Its PPA expires in 2021. We have to look at what happens after that, and we're in discussion with the City of Johannesburg about that. And that's in itself an interesting conundrum in the light of what we've been hearing earlier today and yesterday, because the tariff for that power plant is paid in rand, as you would expect. The fund, my fund, the Pan-African Infrastructure Development Fund, is a dollar fund. And it also raises questions, of course, if we replace this very big, very old power plant with something even relatively modest, like 300 megawatts, which will be half its existing size, we're looking at an investment of over $1 billion. And has the city or does the province have the credit worthiness to support that investment? So all of what we've been discussing today and yesterday is almost encapsulated in this one project. But I was also asked to look at why we don't see more pension funds, municipal funds, sovereign wealth funds indeed, investing in power assets around sub-Saharan Africa. I can only talk about the independent power sector for obvious reasons. But I think in many ways our interests are aligned, no matter who we are. And why do I say that? Firstly, because these independent power assets are almost exclusively, unless they're very small, they're project financed. And the discipline of project finance puts such a robust structure around these projects that they are shielded from a lot of the risks to a greater or lesser extent that we've already been discussing. We have political risk insurance. We have currency management facilities of one sort or another. The risk we find very difficult to handle, of course, is currency availability. There's a difference between currency convertibility and the theoretical ability to take it out of the country, but if it's actually simply not there, what do you do? And that's a looming problem for a lot of these projects in Africa. But nevertheless, power projects by their nature, they have long-term stable returns unless your customer doesn't pay. And we heard yesterday from Globalec that they have a notoriously non-paying customer, at least one. We tried not to go into places where our customer is not going to pay, and we try to put systems around it to ensure that if that customer doesn't pay, somebody else does. I think a very good measure of that is what we heard earlier today about whether governments pay their bills. That's a good indicator of whether you will be able to collect as a utility, pass the cash on to the generator who's delivering the power. None of us wants to turn off the plant, as Henry is threatening to do, and none of us wants to lose our power purchase agreement. As an independent power producer, the most valuable possession you have is your PPA, and you will do almost anything to keep it, because that's your business, that's what you do, that's your livelihood. So I would urge institutional investors to continue to look at power as an asset class that is worthy of consideration for investment. It's not easy. These project finance deals, there's a penalty for terminating the financing early, and when all's said and done, normally you will find the sponsors and the equity will stay with the project. So effectively, you're looking at possibly refinancing debt with equity, which is normally a no-no. So your debt has to be very expensive, and your institutional investor has to be prepared to take quite a low return to make it worthwhile doing that. But I still think it's worth looking at. Thank you.
Thank you, Helen. Moving on to Matsidiso from Rand Water. If you could kindly share the pipeline of projects that you have on the go, as well as touch on your recent capital raising initiatives, and in particular, bond issuances.
Thank you, Chair. Currently at Rainwater, we do have an infrastructure program that we are rolling out, and this is a 20-year program that's actually divided into 5-year plans. And the 5-year outlook, I think specifically we are focusing on the augmentation of our network, which would be to increase actually the capacity of supply by an additional 1,200 megaliters of water that would be supplied per day, and that kind of capacity would actually be able to take demand up to 2035, and as well as looking at the renewal of our infrastructure network currently. We are estimating that we'll actually be investing about over 30 billion in our infrastructure over this 5-year period, with the bulk of the infrastructure investment earmarked for pipelines, infrastructure, as well as our treatment plants. We've got 2 big main treatment plants that can actually provide a minimum of 1,400 megaliters of water actually per day. And for that particular renewal current infrastructure program, we have considered registered a DMTN program that's locally here in South Africa, that we have registered for about 10 billion, and we've issued normal vanilla bonds. There's about 3 that have actually been issued. Of course, we are looking at other different types of instruments, project bonds that can actually be issued underneath that similar program to enable us to differentiate, the characteristics of the bond, to align them with our own requirements, and the requirements being a utility. Would actually be looking at, our liquidity requirements, cash flow requirements, and, instruments that can easily, match those requirements would actually be explored. Currently looking at pursuing, a green bond, being in a water, space, looking at environmentally sustainable investing, as well as instruments that can give us an amortizing profile in order to match our cash flow requirements. I think the other key issues that we'd also like to actually highlight is that within our infrastructure program, we do have specific project-related projects that we have identified and earmarked for project financing, and they think they actually do meet that requirements. We have acid mine drainage projects that we are working together with our shareholder, being the Department of Water and Sanitation, together with National Treasury, amounting to about 10.4 billion. And in this particular program, we actually be looking at constructing, treatment plants that will then now be actually utilized to treat water to industrial grade, and in that instance, would provide us with access to potable water that's currently being supplied to industrial customers. These kind of project, we think it actually meets the right profile for project financing, in a form of exploring partnerships with the private sector, as well as some public sector entities and DFIs, wherein the risk that's actually inherent in a project of this nature can actually then now be shared. And critical risk criteria that is actually inherent in our business would actually be talking to your own credit risk through collection of debts from municipal authorities, as well as the risk of default that's actually inherent in that particular business. The other key project that we have also ring-fenced and set aside for project financing purposes, we're looking at hydropower within our own network. And that hydropower project, we've got about 4 projects in the system, wherein we think we can actually harvest about 13 megawatts of power. And this would actually be our pilot project, because our network is actually so big that if it's actually successful, then we would actually roll it out throughout the overall network. And that project as well, we're looking at ring fencing the cash flows, financing it through a project, financing a kind of a arrangement. What's actually critical is that, at the moment, at least in the water sector, there is some form of regulation to regulate, tariff setting, to ensure that at least there would be some cash flow generation. And in the likely event that the performance is not necessarily as it's actually supposed to be, there is some credit enhancements that the shareholder and guarantees that can actually be provided. But from a utility perspective, we are sitting with a really good balance sheet book with leverage and gearing levels that are way below, I think, 30% at the moment. So we have sufficient capacity to raise additional debt to invest to fund our infrastructural requirements. And what we have actually done, because we're cognizant that in order to be able to operate in the debt capital market, that we need to actually put in place the right systems and reporting platforms that we have actually complied with. We do have an economic regulator in the water sector that actually assists in the setting of tariffs that are actually through a consultation process with the local authorities, because it's important, regulation is also important. And as well, proper governance and financial, reporting that's actually transparent. Those are some of the key considerations that, institutional investors are actually looking at. I think in order to also, to just summarize and to just conclude, is that from our perspective, as I indicated, we want to diversify our bond issuance and our fundraising activities, to look into, amortizing bonds. Our infrastructure program includes a small component of foreign currency. It's about 20% of our infrastructural requirements. And in so doing, we are also going to be exploring raising some Euro-rand bonds, and even partnering with some DFIs through bilateral arrangements to raise this project-specific bonds.
Thank you. And last but not least, Sujoy, if you could very briefly take us through the IFC's green bond and how it's been received on the continent, and opportunities for investors. Thank you.
Thanks. So IFC has been a pioneer in creating opportunities to invest in the climate change based areas. And over the years, this business has actually grown pretty rapidly to currently a $13 billion portfolio of climate-related business. We're probably right now the largest financier of renewable energy projects in emerging markets. And we are doing about $2 to $3 billion a year of business in this climate area. So hence, in 2010, we thought we'd start experimenting with issuance of green bonds. And the green bonds are structured on a use of proceeds basis, which is that the investors in the green bonds are actually taking the IFC risk, which is a AAA risk, but the use of proceeds are basically dedicated to projects that are delineated as green, as climate-related projects, and this is audited and reported upon on an annual basis. So what started as a relatively small program has actually blossomed into a $5 billion program for us. And the couple of other things that have happened, which are actually quite interesting, we've started now issuing, we've done 2 issues of our benchmark bonds as green bonds. Now, the benchmark bond means that these bonds are used actually to basically price the IFC risk. So these are clearly very important issuances for us. This March, we issued a $700 million benchmark bond, which was green bond, which was twice oversubscribed. So clearly, it's a space where we are able to bring in new investors who are seeking this kind of investment. Now, the other thing that we clearly observed in the renewable energy, particularly area, is the need for local currency long-term finance. Mm-hmm. So then we decided to progress the green bond program into issuance in local currency. And November last year, we issued what we call a masala bond, which is an Indian rupee bond on the offshore London market, which was very well received. And this allowed us to put together a core of Indian rupee financing, which is available for Indian rupee projects as they come along in the climate space. And then in November, we launched a South African Rand green bond program in South Africa, which again is the same purpose, which is that it's basically allowing South African investors who want Rand exposure to actually get the IFC credit, have a Rand exposure, and also tie those investments to green or climate-related businesses. So basically, 2 key messages. First is, the green bond program has been pretty successful for us, and I think it's a very interesting space, becoming a more and more interesting space for institutional investors to invest into. Second, it is available in different currencies, including in South African Rand. So look forward to your participation in the next issue that we bring to the market. Thanks.
Thank you, Sujoy. Is there time to open up to the floor for questions?
Are there questions? Jeff, anything with the question? Oh, okay. I think everyone's tired. Is that true?
Okay.
Oh, okay. Question.
Thank you. This question is directed to IFC. I think it is really historical known that in terms of closing the transaction, it takes a lot of time in terms of IFC to approve the transaction. To issue a green bond, how long does it take you?
So now we are talking about the liability side rather than the asset side. Now we've been discussing for the last 2 days that project finance in difficult markets is not easy. And on the asset side, clearly, something that, for example, Helen also referred to is when we are structuring projects which have multiple risks and need to be structured along those various frameworks, sometimes it takes time. Sometimes it actually works pretty speedily if the market space, if the sponsors work or the promoters work, and all the other frameworks are in place. But that's on the asset side. On the liability side, we actually have to operate much faster because it's all market-based. And basically what we are typically doing when we are issuing bonds is looking for opportunities to issue bonds into markets at a time when pricing is attractive. I mean, that's really what we're after. And we are also trying to address needs of institutional investors who might be coming into the market at a certain point of time. So it's really, from a perspective, of an investment banker, it's basically really once they have the investor lined up, I mean, it's very easy because typically we are issuing in markets such as New York, London, Johannesburg, which are markets which are quite liquid and quite used to operating in the bond space. So on the liability side, I would say, and sometimes you have to make up your mind in days, if not hours. So that's really the difference in kind of the speed to market on the liability side as opposed to the months that it may take on the asset side.
Any further questions? So we've come to the end of our session. We'd like to thank our panel participants for taking the time out and sharing their insights on projects on the continent. If we could kindly give them a round of applause, please. Thank you.
Doing business in Africa. You can't afford to be without Africa Investor.